Dr. Stanley Okoro. I'm the president of ANPA Foundation, and I want to use the opportunity to welcome everyone to our 25th webinar. Yes, number 25 since 2020, talking about everything financial ANPA. Today, we're very excited to present Diaspora Investment and Charitable Life Settlement Funds. This is something that a lot of us don't know. Today's webinar is co-sponsored by ANPA and ANPA Foundation. I'll be your moderator for the time, about an hour. We should be done in an hour. But before we start, I just want to kind of talk to you about ANPA. I don't think our president is in another meeting right now with sickle cell. ANPA Georgia ran a 5K today for sickle cell awareness. So as you can see, ANPA is a 501(c) organization incorporated in 1995. We represent a lot of doctors, over 4,000 physicians and dentists and allied health professionals of Nigerian birth and ethnicity. There's many benefits of ANPA, joining ANPA. One of them is professional development, leadership opportunities, practice referrals, networking, supporting times of need and joy, medical mission, volunteerism, and stuff like financial education, actually. So that's what ANPA does. And there's many ways to connect with ANPA. The ANPA website is ampa.org. I am the president of ANPA Foundation, which is ANPA's sister organization. Our focus is really to help create a financial stability for ANPA itself and its members, to bring opportunities like this so that members can learn how to be financially stable. These are the ANPA Foundation board. As you can see, there's about 12 of us that make decisions for ANPA. And all we do is about philanthropy. ANPA's financial webinar is now a quarterly webinar. It used to be monthly. We've pretty much covered everything financial. Today is our fourth quarter/third quarter, which is past webinar. The webinars are normally at 12 noon. It's 1 hour only. We will be done around 1 p.m. hopefully. This is an intentional aggregation of subject matter experts. We guarantee this will be the highest and best use of your time during the noon hour and Eastern time. It is free to ANPA members, so please share that. This is our disclaimer for ANPA, all ANPA financial webinars. The materials presented at all ANPA webinars is for general education purpose only and is solely the opinion of the presenter. No webinar is intended to provide personalized financial or legal advice. It is left to the discretion and judgment, and it is the sole responsibility of each attendee to determine what is necessary for his or her own practice. Neither the speakers or ANPA can be held responsible for the materials, opinions, and any either advertent error or omission in the preparation or presentation of the material. Further, nothing in the material should be construed as an endorsement by ANPA. Again, today's webinar is co-sponsored by ANPA and ANPA Foundation. I will serve as your moderator. Today, we have the subject matter experts in Kano, who is no stranger to ANPA, is our financial expert. And we have Frank Odell, who is the managing director and CEO for Biltmore Consultants. He will have the opportunity to share this information with us today. There's another disclaimer from them, very similar to what we said. So pretty much the information that you receive today, discuss it with your financial advisor and your attorney if if need be. I'm going to have, this is what we're going to talk about today. This is for, to the rate, I'm going to have Amy talk about this, but Life Settlements Fund is something that is not available to a lot of people. So this is a privilege for us to have this opportunity to learn about this. And I learned about this about a year ago. And what I've learned is there's no correlation with stock markets, housing, interest rate, the economy. And I'm just excited for you guys to hear about what other people enjoy. Without further ado, I'm going to introduce Amy Kanu, who is a speaker, a leader, an entrepreneur. He's helped us, including myself, minimize taxes and transfer multi-generational wealth to our family members. So without further ado, Amy, are you ready to take the reins from me?
Sure, Stanley. Thank you very much. I hope everybody can hear me.
Can you speak up just a little bit?
Sure. Can you hear me? Good morning.
Yes, I can hear you.
And maybe good evening if you're in part of the world where it's 5, 6, or 12 hours away. Stanley, thank you very much. This is, there are really two things we want to accomplish today. Stanley, you want to move away from me and let's go on to really okay. Well, if you guys know basically what we're about. Stanley talked about the aggregation of experts. We look at ourselves as an all-star team of financial experts and resources all over the world. Subject matter experts, thought leaders, all of that stuff. People who are really specialists in their various fields. Those of you in medicine understand the edge of specialization. So when you look at LeBron James and Durant and all that stuff, you kind of appreciate what expertise is about, Curry and so on. So we've got the likes of those on our team as experts. Next slide, please. Basically, we have a club that is focused on providing 5 distinct services: tax planning, risk management, wealth management, have a legal advisory team and a business advisory team. When you come in, it's as if we're triaging you through a hospital, take you through the process. And if you have an acute issue, doctors, forgive me. My wife is very unforgiving of me when I start talking like I'm a physician. She reminds me that I'm not a physician. But when you come to us, typically you come in, either you have an acute issue or you're trying to get to something. The acute issue could be one of these areas, and then we would address that and hopefully then kind of triage you into the other things. If you come in and you want to be a member of the club, you become, you go through the process. That's where you get the benefits of what we call transformation powered by trust, trusting our mission, our focus, and our solutions. Go on to the next slide, if you will. Here's the deal. Today, we're talking about strategic investing and investing in a solution or something that's not available to most people. I tell the story a lot of times. People, when you start out somewhere. You get good advice, and then you may outgrow that advice depending on your situation over time. What happens is you outgrow the advice, you may or your advisor may not know of the solutions and strategies that the 1% to the 5% out there are using. This investment is one of those that's not available to everybody. You have to be accredited, and an accredited investor is a single person who's earning a couple of $100,000 a year historically, and that money continuously in the future. If you're married, $300,000 and a net worth of $1 million. So the accredited investor, this is for accredited investors. As an accredited investor, you have things that you're exposed to and available to you that are not available to the 95% of the universe out there. This is one of them. And I want you to look in the top left quadrant of this matrix, because a lot of people seem to think that you have to take more risk to get more reward. This investment is in the top left quadrant. Low risk, high reward. Frank, my friend, is going to talk about this, and we're going to chime in. This investment is anchored, my friends, in life insurance. You can see the spectrum there. The spectrum goes from life insurance, where you have low risk and principal protection, to high risk, alternative investments, private investments, all those kinds of things. Now you can amplify results. This investment, my friends, is anchored in a portfolio of life insurance. Life insurance, and one of the things Stanley likes to, he touched on this, Stanley likes to talk about a life settlement fund as one investment that is anchored in the certainty of death. I don't know anybody here that's not going to die. Everybody here will die. So what I want you to do is imagine every single person here had a life insurance policy that they sold to the fund. At some point, the fund will cash in on the death of every single person here. Death is certain. So I'm going to bring on Frank. Frank is, my partner in crafting this. What we did, by the way, is we created this particular fund and the raise for ANPA, the Diaspora Fund is primarily for ANPA, to benefit ANPA. The thing about it is we want you to invest and think about this as a growth investment, and at the back end, to also give some of the benefit to ANPA. 10% of the proceeds in this thing will go to ANPA. Frank is going to talk about this. Frank has been, basically kind of working in financial services and consulting for over 30 years. And we've developed a good strategic relationship, and we're going to run this fund together for the benefit of ANPA and so on. Frank, I'm going to let you go ahead and talk. Take over.
Great. Can everybody hear me?
Yes, we can hear you, Frank. Go ahead.
Great. No, I'm very excited, about this opportunity for everybody. It probably is, NE has impressed upon us that we're not only looking for returns in your investment or our investment, but we're also ensuring that we are protecting your principal. And as NE has said, everybody's going to die at some point. And the way we look at life settlements is it's a matter of time. So a life settlement transaction is really simply, it's the purchase of a life insurance policy from the owner, the insured, and we become the direct beneficiary of any type of death benefit. So what is an amazing statistic is that 92% of all insurance policies written never go to claim. And it's because people are tired of paying the premiums. They can't afford them. They decided that it's not, that there's no value there. And so these policies just terminate. In our language, they lapse. So we see an opportunity, and we've taken advantage of this opportunity in other funds, and we wanted to create a Diaspora Investment and Charitable Life Settlement Fund because we see it as an opportunity not only to help and create a healthier Nigeria, but also a healthier world. So we have a private placement memorandum. We're looking to raise $10 million. And through that, we will capture upwards of $60 or $70 million worth of life insurance settlements. And of course, 10% of that, as the settlement comes to fruition, will go to ANPA. Next slide. Yeah. So to reiterate what Stanley said is, this is a very low risk investment. It's not a function of if we're going to have a settlement, but when we're going to have a settlement. So we're looking to raise $10 million. These have no correlation to any type of variable investment, right? If we buy a life insurance policy that has a $500,000 death benefit, we're going to get $500,000. There's no question about it. It's just a function of time, and that relates to the rate of return. So no volatility. The death benefit doesn't go up or down. Low risk because the somebody is going to pass away, and there's a significant return because we are buying these policies for 20 cents on the dollar. And we have done this for now going on 10 years. In this package, there's a slide that shows a policy that we recently closed, and you'll see the returns. So one of the companies that we work with is Richmond Life Settlement, and Richmond Life Settlement evaluates the policies and what the opportunity. So we also, what a lot of people don't know in terms of life insurance is that premium payments that are made, we can actually manage, and we can optimize, and sometimes we can save 20 or 30%. So we also process all the paperwork and identify the settlements. Next slide. This is a really good slide. So, it's why do people sell their policy? So a lot of times they as doctors know probably best is that, as people age, they can no longer afford the premiums, and the go forward premiums. A lot of times they no longer need the policy. Their children or their heirs have been successful in life, and the $500,000 is not going to make that much of a difference to them. An important piece here, as we're all seeing, and again, as doctors, you know this better, people are living longer. And so they need the funds for the long-term care. And we can provide that. Medical costs have increased. They just need, the insured just may need to fund other expenses in their life. I mean, a good example of this is we bought a policy from a woman, and we paid a good price for it, but she wanted to take her children and her grandchildren on a cruise. She was at the end of her life. We paid for her, we bought her policy. She used that money to take her family on a life-ending cruise, if you will. Oftentimes, some of the insureds have multiple policies, and so they're over-insured, and this gives them the opportunity to monetize that. But yeah, there are a lot of reasons. So kind of in terms of the process, right? Here are the partners in this transaction. So there's the policy owner, or we call them the insured, right? There's the seller's advisor. So usually that's a financial advisor or an insurance broker that is working with the seller. There's the life settlement broker, which is the company that can actually buy and sell these policies. It's important to understand that as an individual, you cannot buy a policy from somebody else. The insurance companies don't allow it, nor does the government. You have to be a licensed broker and a licensed funder in order to transact the business. And then there's the investors, and that's us. Next slide. So what we do is, first of all, we only deal with A-rated insurance carriers. So it's important that we review the policies thoroughly and understand kind of what the intricacies are of the policy. So although it's a simple investment, right? We're buying a life insurance policy. There's a lot that goes behind the scenes in order to complete the transaction. So we vet the transferability of the policy. There are some policies that aren't transferable, although people think they are. We want to make sure that there are no stipulations. And one of the big questions that we get is, are there suicide clauses in? And we won't buy a policy that has a suicide clause in it. It's just distasteful, over and above the fact that most of the insurance companies won't allow that. We participate in a national prescription database. So we understand kind of where the insured is in terms of medications that they're on. We get the medical records from the physicians and from the hospital. They have to sign all the HIPAA forms. And so here's an important step, and I want to make sure this is clear. Once we compile all of the information, we send that to a third party. The third party that we generally use is General Ray, which is owned by Berkshire Hathaway. They analyze all the medical records and the health of the individual, and they assign to that individual what's called a life expectancy. You'll hear us use the term LE often. So we don't have anything to do with that. We send that to experts. We also use subject matter experts to make sure that the life expectancy of this people, based on the medical records and the health of the individual, is firm. And then, if we have a profile of cases or models that we use, and we put that into inventory, and we'll evaluate those over a period of time. Next slide. So here's the process, right? Is that, we find a policy that we like, we make an offer to the individual or generally the broker, the insurance broker. And once the offer is accepted, right, we go into closing process. The closing process is intense, to say the least. I mean, we work with the insurance companies. The insurance companies vet the policy, make sure that it's up to date, make sure that there's nothing in that would preclude us from owning the policy. And that generally takes, the closing process on a per policy basis generally takes between 4 and 6 weeks. So again, we work through the insurance companies to make sure that when we get a policy, that we can actually own the policy, and that everybody has signed off on it, the appropriate releases and everything else, so that there's nothing left to question, if and when the insured passes. Next slide. So again, and Stanley, thank you very much for adding this slide, because sometimes we've talked about this so much we forget that we're familiar with it, but not everybody is. So in terms of evaluating the value of a policy, right, we want to take a look at the insured's health, right? So again, we're not doctors, we're not experts, but we gather all the medical records and send those on. So estimated life expectancy. So this is an important piece because this actually determines what your rate of return is going to be. So we like policies that have a life expectancy of less than 5 years. However, we also like policies where where the life expectancy is longer than that, because the price that we pay for those policies obviously is less, right? As you might imagine. And one of the things that I don't know when or if you're going to talk about this, but one of the things that we will do, especially for our longer our policies that we purchase with a longer life expectancy, again, in tune with the protecting principle, is we will actually insure those, so that if something were to occur, we have an insurance policy against it. So the face amount of the policy. I mean, we're not looking for a $5 or a $10 million policy. because they're very expensive. But $1 million, $1.5 million, we've built portfolios on $1 million policies. One of the reasons why we do that is when we go up market, when we try to buy a $10 million policy, we're gonna compete with Coventry. We're gonna compete with all the big players because they're the ones that want those policies. Whereas if we stay down in kind of our space, we don't have that much competition. There's not that much bidding. We really focus on the insurance premiums because that's where your tail risk is, right? So when we look at a policy, we like to evaluate the rate of return or the IRR, either one, at life expectancy +2. Because even though 80% of the people 80% of the people pass within their life expectancy, but 97% of people pass within life expectancy +2. And why we evaluate that is because we've got to keep the premiums up. So we've got to continue to pay for the premiums. How we capitalize on them is we buy and we hold them. That's our primary strategy. And people pass, we get the death benefit. But the other piece to this that's important to understand is that there is a secondary market. So we would buy policies, and as we approach life expectancy, those policies become more and more attractive to the secondary market. There's value in them. So we can resell those policies, and we may not get the 21, 22%, 30% IRR, but we'll probably get a 15 to 20% IRR. We have a little tagline that we like to use is these policies are vintage, just like a really good wine. As they get older, they become more valuable. Excuse me. Next slide. So here are a couple cases that are pretty good. So we focus on males. Women just have a tendency to live long. So we focus on males that are 70 years and older. So in this particular case, we have an 82-year-old male. The death benefit was $250,000 with an LE of 5 years. His premium was $8,000 a year, and the purchase price was $25,000. So we bought this policy for 10 cents on the dollar in terms of the face value. Okay. So again, I'm going to go from the bottom up, but what you see here is at LE +2, which means that we have paid several years of premiums. You have an internal rate of return of 29%. So on a $25,000 investment plus 7 years times $8,000, so plus what is that, $56,000, right? On $250,000 payment, we net $160,000. On LE +1, we get a 33% return IRR and a net present value of $188,000. And assuming that they pass within their LE, then we're looking at $199,000 on an investment at that point of $290,000. So, I'm sorry, of not 290,000, 25 and 40 of 68,000. I've still got another one, Stanley. So, here's one that's larger. 75-year-old man, $1 million policy, 5-year LE, right? The purchase price on this is $150,000, so 15 cents on the dollar. But again, the same premise, LE +2. So again, we've paid the premiums. We're netting $697,000. LE +1, $726,000 and a 33% IRR. And at LE, it's a 45%, let's call it 46% of $755,000. So what's important to note about these slides is that, we have to manage the premiums, right? But even if we extend over the LE by 2 years, is that, we're at a 27% IRR. And going back to kind of other investments, there's not an asset class out there that can provide this type of return. And again, I don't want to say it's guaranteed, but the death benefit is definitely guaranteed. There's no question about that. Next slide. So here's the benefits of a fund, right? It is that when you invest with a fund, you invest in a pool of policies, right? So, we may have 50 or 60 policies in the fund. In this particular fund, we may have more, but you get the benefit of the numbers. You have no premium payments. The fund covers the premium payments for the policies. Now, what we do is on the investment, we will take 30% of the investment and we will put that into a protected account that is strictly for premium payments, so that we're always covered. Listen, as you do a little bit of research, there's a company out there that several years ago was a life settlement company that actually filed for bankruptcy because they didn't escrow the premium payments. And that's the most important thing, because we do not want these policies to go into lapse. If they go into lapse, that's essentially termination. So we're very, very careful about that. There are other opportunities in terms of distributions. So we use all kinds of professionals. It's not just any who's extraordinarily capable from a tax planning perspective, and Canoe Asset Management. But, again, we use Robert A. Jones. They've got a network of 7,000 life insurance brokers. So we get quality inventory, we get quality policies. We use General Ray in terms of setting up the life expectancies, and we'll manage the fund carefully. And I can't stress it enough. I mean, there is little or no risk. I mean, people are going to pass away. As sad as that is, they're going to pass away. And we're going to get the death benefit, for that policy. The risk is not what we get back, but how much we end up paying in terms of the premiums and where we are with the life expectancy. And one of the ways we mitigate that, to go back to one of the other slides, and we don't have to go back, Stanley, but to go back to one of the other slides is, if we have a policy that is approaching life expectancy and we are concerned in terms of continuing to pay the premiums after that, we sell that policy. Some of the larger buyers will come in and buy it. So unfortunately, I am on my, I'm at a hotel, so I'm on my phone. So this is a little bit small for me. But if you take a look at this is our model. I'm going to get on my computer also, because this is an important slide. So as you can see, our model is primarily males, 75 and older. Hang on one second. Let me just give me 1 second. So it's primarily males with life expectancies of 5 years or less. So on this slide this is one of the portfolios that we manage. And if you just take a look, of the policies, there are 3 females and 2, 4, 6, 7 males. Look at the life expectancies, right? I mean, the life expectancies are under 5 years, essentially. Just Irwin Goldstein is 6.1. Here's what the death benefit is, the next column. When we purchase the policy, and then the actual hold period for the policy. So as you can see, most of these insured passed away before their LE, before their life expectancy. Right? And this is actual data. This is an actual portfolio. So we can see the total amount that was invested, and then you can see the net proceeds and the gross proceeds. So on $6,600,000 worth of investments, right? We netted a profit of 1.5, almost $1.5 million within less than 3 years. Again, it's not a return that you're going to get anywhere else. Next slide. So let me go to my next slide. Again here, hang on. This kind of just tells you kind of how we build the portfolio, right? So essentially on this for this fund, we control over $13.3 million in death benefits in terms of overall policies on investments of $3.1 million. So we're looking for return. Important to note here, right? Is that if you look at the third line, claims proceeds, you see that we did not have a settlement during the first 2-year period. So the thing I want to stress about this is that an extraordinary lucrative investment, extraordinary lucrative asset, but it's also got to be a bit of a patient asset, right? Because we are buying a policy at an opportune time, but they probably don't pay out for, for 3 years. Again, our LEs are 5 years. So we're expecting a payout within 5 years, which is happening here. Next slide. That's it.
That's it.
So yeah, Annie, you wanna take it back and
Sure. Well, good. Hopefully this kind of gives you guys some insight into the underpinnings of all of this. So why this opportunity? For you, my friends, it is an investment opportunity. It is not an income opportunity. It is a growth opportunity. Right. So this you need to think of as long-term money. You're looking to put $1 in and hopefully get $3, give or take, $2, $3 at the back end. But it's not money that's you want to have any need for in the next few years. Our $10 million initial capital raise in this instance would control, we expect to basically kind of build out to maybe 2-3 times in death benefits, hopefully more. But what does all that mean? For you over a 10-year time frame, I want you to think 10 years. It doesn't mean that this is going to take 10 years to yield the results. But we like to set those expectations so that people are not looking at this as something that's going to pay off tomorrow. What will happen is in the first 3 years, we're not going to pay out anything because we're building and fortifying all of this stuff. And if there are any deaths, you saw in the last illustration, there were no deaths for a couple of years, even though the life expectancies were 5 years or shorter than that. Even if we get those things, those monies are going to go into an escrow that we would basically set and start the distributions in the 3rd year. So what does all this mean? Your $10 million would control 3 times that, give or take. You're going to get 3 times, give or take 2-3 times that in proceeds. You're going to give to the association, ANPA, the foundation, donate is the word. So you get a tax deduction. So you're not only getting multiples of your investment, you're going to give the ANPA Foundation 10% of that money. The 10% is not coming 100% from you. We are also participating in that. Our normal fee would be, 20%. We're giving up 5% of that. So we're taking 15%. So most of you may have heard about 2 and 20 and things like that. But we're giving up the 5% of the fees on the back end. We too want to get the tax deduction and things like that. But at least it helps ANPA. So if we end up with, I want you to imagine this in quantitative terms. We raise the 10 million, we build out to 25, 30, $2.5, $3 million. That's $2.5, $3 million of monies that are going to ANPA Foundation for the benefit of ANPA. In the meantime, you're keeping the bulk of that money. You can stay in the back in that one there, the one before that. So you basically are investing for yourself first, growth on the back end, and you're also benefiting ANPA. So here's the deal. We really are asking the investment amount to be $100,000. We've made modifications. A minimum of $51,000 would be the investment to participate in this. This is not unusual, by the way. When you start dealing with accredited investors, you're talking about fairly substantial sums. One of the things that we have done, so really it's a $100,000 investment, $51,000 is the minimum, but we have made an investment exception. That investment exception, the operating word there is exception, my friends. We could accept, in certain instances, we could accept $26,000 as an investment to participate. So that's it. I'm going to open this up for questions so that we can answer your questions.
And thank you very much, Frank. Thank you very much for your time this afternoon. I know some of us have some questions. So the format for questions are, you can unmute yourself or raise your hand. I will recognize you. Or you can put your questions on the chat and I would ask the questions for you. So it's pretty open mic at this point. No questions are off limits here. So you can also text me if you don't want to ask a question. But Frank, one of the very first questions I received on was, I think you answered it. What happens when the policy is over the 2-year LE? Do you hold it or do you sell it?
Frank, you want to answer or you want to answer?
Again,
go ahead.
So we'll evaluate it. We'll evaluate the insured. We can ask for new medical records to understand kind of where their current health is. And then we'll make the professional decision that says, no, let's continue to hold this policy and continue to pay the premiums. Or if we put it out to market, right, what are we going to get for it? And again, like I said, we're certainly going to get more than we've invested. Rather than a 30% IRR, we'll probably get, a 19 or a 20% IRR if we sell it into the secondary market. The point being is that there is other liquidity.
What is the typical liquidity event? What does that look like, Frank?
So it's a death benefit. So it's a death benefit, Stanley. I mean, it's the insured passes. And when the insured passes, it takes literally between 4 and 6 weeks for the insurance company to actually generate the check. So they would generate the money to the fund, and we would look to reinvest that in other policies. And it's a similar situation if we sell the policy. So if we take the policy and we sell it to Coventry, which is kind of the safety net, then we transfer ownership or we transfer death benefit to the buyer. They pay us, and we would look to reinvest that money into buying new policies.
Okay. I got the first question. Says the cost on the investment or profit is about 25%. Can you see the comments? Or it says 10% to ANPA Foundation and 50% for the managers. I guess that's what they're saying.
Yeah, I think that those are kind of the. I mean, if you want to calculate it that way, those are the administrative costs for the policies. But remember, none of those costs are expensed, if you will, by the fund until there is a liquidity event. I mean, nobody's getting any money up front here.
Okay.
So we're all, we look at this as a partnership, right? I mean, we're all in this together, and it's a patient partnership is the way I like to phrase it.
Okay. Does anybody else have any questions? We have about 13 minutes to be done by 1 o'clock. So this is a 1 hour webinar. We will be done in 13 minutes. Henry, you raise your hand. I will recognize you after Henry, then Dr. Cliff Eke. Henry, go ahead.
Question, how many years is the investment going to mature?
If everybody died in 1 year, then we have a 1-year maturity. We don't have that crystal ball that would say everybody that's in the policy will die within a specified period. We're using expertise to make the determination as to life expectancy. Now, having said that, I mentioned a 10-year time horizon. I will say to you that our goal is to exit this, to monetize and mature, if you want to use your word, mature, in about 8 years, give or take. Okay, and what we're going to do is anything that's hasn't paid off at that point in time, we could monetize in the secondary market, and then we're going to make that decision at that point in time. By the way, whether to continue for another couple of years, depending on what the portfolio looks like at that point. Keep in mind that you're getting a stream of income or proceeds before that time. So you're going to have only a proportion of that in the portfolio at the time. So when I say an 8-year holding period or a 10-year holding period, you're still going to realize proceeds. So you're going to get investment returns. And each of these would pretty much have their own very specific rates of return in relation to your total return in the portfolio. So when we get to the 8-year period, depending on what's left in there, we might just kind of liquidate the whole thing and shut it down. And then if somebody wants to participate in another program, they can do that. If you want to take your money in this program and participate in another program, you can do that. So this is something that it's pretty much structured to be ongoing, but will terminate.
And I would have to recognize our president-elect, Dr. Cliff Eke. Cliff, you can unmute.
You're too kind, Stanley. Well, thank you for the presentation. The investment makes sense. But I was hoping, since we are buying as a group, why can't the money be less? I mean, most of us have so many competing factors, both here and in Nigeria. And we didn't save money and keep it there, 50 grand, 100 grand for this to come up.
Yes.
My thought is, if the investment was less, 10, 15 grand, you can get more of us to join as a group, because we're not buying individual investors, is what I understand. So that in the examples that were given, the purchase price was like 150,000, 250,000. And you can easily get that from the foundation or ANPA as a whole. And then add it to other people and we'll buy in bulk. I think we might be able to, get further with it. That's just something to think about, if it's possible.
Well,
Thank
thank
you.
you, Mr. President-elect. Let me respond to that, if I could. I understand your forward-thinking hat in this regard. The challenge we have is typically we would look for, and you might recall I mentioned this, a $100,000 investment is more typical, if not more. So we went from 100,000 to a minimum of 51, and I mentioned an exception of 25. So here's a suggestion that I would make to those who might want to participate. And you can kind of handle this as, get together 2 or 3 people who want to put less than whatever the minimum is, whether it's the 50 or the 100, and then invest in that context. The reason that's important is keep in mind that we've got operating costs in this thing, okay? If we start making this thing $10,000, $15,000, to get to $10 million, we're talking about 1,000 people, okay? We need a TPA. We're going to be paying a TPA to do all this stuff. There's a lot involved in, just making the investment. So I hope that this answers your question, Mr. President-elect.
Thank you. Thank you. Appreciate it.
Thank you. We'll recognize Patrick and Joko. You can unmute yourself, Patrick. Patrick, we can't hear you. You're unmuted. While we're waiting for Patrick to fix technical issue, would you say that this investment is a long-term investment with an average in quotation of 5 to 10 years?
Yes.
Okay.
Yes.
And would you also say that the average return will be 2 to 3 times your original investment?
That's a safe expectation, my friend.
Expected return.
Yes.
Okay. Patrick, are you still there?
Yes, I am. Can you hear me?
Yes, we can hear you now. Go ahead.
Okay. 2 questions. First was a comment. I think the first time I heard about this, I actually brought it up with one of my the insurance person that I've worked with before, and I guess it's more of the initial effect in terms of waiting on people to die. But I think obviously it's an investment model that is there that one can take benefit of. But that was kind of the first hurdle for me thinking about it. And I don't know what AU will have to say about that and whether this is something that can stay in the long term. And then the second part is then I think you talked about proceeds or dividend being paid out after the first 2 or 3 or 4 years. Is that built in? Can it be built in, for instance, that it kind of rolls over and some of that dividend kind of adds to one's initial investment as the years go by? And then the third and final one would be for the spatial one that you talked about, the 25 or 26,000. What is the mode for payment, and when can that start? And if one can have an idea of how to do that. Thank you.
Sure. Question number 3, if you look on, I think on the slide deck right now, you have the Talk to Us piece. You can go here, or Stanley, go to the one before that, if you will. Because I think the one before that is specifically for the indication of interest. If you're interested in investing in this, here's the QR code. If you are caveman like me, you can call our office, 513-769-2700, and somebody on our staff will work with you to kind of get you any information you need additionally. But what I hope happens, go back to the slide before that. I don't want to focus on that. What I hope happens is that when you go here to the QR code, and those of you who just put your picture on this thing, it'll take you to a page where you put how much you're looking to invest and all that kind of stuff, and then we will reach out to you. What we're hoping happens is that everybody here would have an interest in some way, shape, form. Okay. And as look, I like the sound of president-elect. I can't wait. As Dr. Cliff Eckell, president-elect, or the president-elect, talked about earlier, maybe if you have a smaller investment amount, maybe we can make introductions to you guys to talk about how you can collaborate or do stuff together to meet those minimums. So what we're not trying not to do is just kind of make this thing overly cumbersome. So hopefully that's helpful. If you go to the QR code, put in your indication of how much you think you can invest. 100 million would be great, because we can set aside a special fund for you. 100,000, 200,000, whatever it is, and whatever the number is, put that number there so we know. What that will do is that helps us. And I'll share something with you that's important. The earlier we get this upfront money, the earlier we can start buying policies, because we designed this for ANPA. Okay. Another thing I want to throw out there is, if you know associations, or there's something that's called a sidecar investment. Okay. A sidecar investment is you're bringing along some other entity that could have a similar interest to help facilitate stuff like this to happen. Okay, so they would have their own little pot, but they're riding along with you. And if we can raise 10 million, we can raise 20, and we can raise whatever the number is. So if you know of any associations that could benefit from something like this, invite them, and we can join them in a sidecar program that will be for their benefit. Yes, it's not going to benefit ANPA. Maybe we can structure something. I don't know. We'll see. But the bottom line is, these are some of the ways that we can do this. So I want you to go there, put your let us know what you're interested in doing.
I posted the link, because if you're on your phone, you can't scan the QR code while you're on your phone. So I posted the link on the chat. So for those, I can copy the link to take you to the same form. Yeah.
One thing I want to point out, I don't want anything to be lost in the fact that this is your investment first. You need to allocate capital for growth. This is a great place to do that. Frank talked about how we mitigate risk. And if you remember the 4 quadrants I shared earlier, the top left being high return, low risk. There are ways we mitigate risk using insurance to accomplish that, so that we protect the investments even so. So
there's a question on the chat. In terms of timing, so when do we expect to start the funds? This particular fund?
This is an excellent question. Thank you. The fund is substantially ready to go. If you give us your indications of interest, we will work with you to essentially get the funds escrowed. And once we get to 1 million, we can begin to buy policies. Because we designed this for you guys, we want to raise a certain amount of money before we start buying policies. Okay. So if you can get us $1 million yesterday, we will set aside 40% of that towards policy and servicing the premiums. I'm paying for premiums. And the other 60% we're going to allocate to buying the policies. If you remember, in the case that Frank shared, we bought a policy for $25,000 and they're servicing it for $8,000 a year. So if you recall, those are the kinds of dynamics that we have to make sure that we have in place.
Okay, Annie, the next question, is there any tax benefits right now, or just after the distribution?
Excellent question. You can put it in your IRA. You can get a tax deduction up front. That's not typically the strategy we recommend, but that's what the 95% would do, because they want to get a tax deduction. The 1% to 5%, which you guys all are here, you really want to use after-tax money to do this, so you're not paying taxes on your multiple on the investment. So you can do it in a Roth IRA, for example, and you can structure things to kind of get that. So the tax benefit is one. If you do it in a Roth, you get a triple, 2 times or 3 times. The second thing is you get a tax deduction on the back end for donating to ANPA Foundation.
All right, Amy.
Investment first and foremost.
Thank you very much, Amy. Is there any other questions before we end the webinar? This webinar is being recorded. We're going to repost the link for everyone else to, those that missed it can listen to it. For those who are interested, go to the chat right now and copy that link. Or if you have a second phone, scan the QR code to indicate your interest in this. And we will be sharing more information on the ANPA channels. I want to use the opportunity to thank Amy for helping us put this together. Also to thank Frank for taking out Saturday to educate us on this investment opportunity. On behalf of ANPA and ANPA Foundation, I want to wish everyone a very wonderful Saturday. Have a wonderful day. If you have any more further questions, please reach out to me personally or Amy. This is the contact information again. You can do a screenshot of this or screenshot of that. I'm going to show it again before I end it. We promise you that this is going to be 1 hour, and it is 1 hour exactly. So we will, all of our webinar starts at 12 noon sharp, ends at 1 p.m. sharp Eastern time. Everyone have a wonderful, wonderful weekend. It's been a pleasure. Thank you.
Thank you. Have a great day.
Good job, guys.